I'm Jeremiah Boucher, a commercial real estate investor with over 20 years experience. This show is designed to help you build your business, become a better real estate investor, and help you see opportunities that will keep you ahead of the competition. This is Finding Your Edge.
I had a question, Warren. You got to tell us, so what was the transition to the triple net? And then you got to tell us the Jack in the Box story.
So I didn't find a lot. The market in 2013, 2014 kind of started shooting up in LA. And I wasn't finding at the time, when I first started buying buildings, I thought, okay, 8% is kind of my minimum. That's going to be like the threshold where I can raise money from investors.
And you say cash on cash, 8%?
Yeah, cash on cash. I was wrong because during COVID, I was buying buildings for much less. Cash on cash day one. But at the time, that's kind of what I thought based on the few deals that I put together. So LA was going up and I just wasn't finding deals that kind of made sense in my mind. So I started looking at triple nets out of state just to diversify. And the first one I found was a Jack in the Box in Louisiana. So I left out of my bio for 3 years. I ran a billboard company. We were building digital billboards. We were one of the first companies in the country to start building digital billboards.
Oh, wow.
We were doing it in Baton Rouge, Louisiana.
Wow.
Right under the nose of Lamar, one of the biggest.
Wow.
So needless to say, they were never happy or excited that we were in town doing it. So we ended up selling that business. And around that same time, so I knew the Baton Rouge market pretty well. And within maybe 6 months or so of that happening, I saw this Jack in the Box come on the market at a 12 cap. And so I was intrigued. I wanted to find out what the story was. And so generally, not a lot of people want to buy in the South, specifically in Louisiana. The taxes for transfers are high, and there's just the market generally there is not. People in California don't really want to own. People in New York don't really want to own in Louisiana. I think the perception that there's a lot of contamination in the soil from all the oil and products that they make there, and whatever the reasons, some valid, some not, depending on where you are in the state.
And the rule of law is different too, right?
Just everything's run very differently. So I was comfortable having been there, running a business there. And I mean, it was like the Wild West trying to deal with people in Louisiana, like the distraction of a billboard business, trying to rent space for $500 for a month. For ad space, dealing with a dentist, that just wanted to grow his practice. Or our biggest client was a car company that sold cars, and they hated Lamar. They had like this issue with Lamar, so they came to us, and it was like fantastic business from them until the owner had some health issues, and so they were pulling back from advertising. But we were doing like $8,000 a month, say, just with this one dealership that had multiple brands that was advertising on our digital boards, on some of the major highways through the city. So anyways, so I saw this deal, LA brokers, actually an LA owner, because most of the triple net, shockingly, across the country is owned by California and Northeast money. They probably own, like I own, multifamily, or clients own multifamily. They want to get out of rent control or tenants and toilets or whatever they're trying to get away from. And so they buy out of state. And so the most of the buyers, even for syndication, I feel like when I look at other like deals I invest in and I look at where the money's coming from, a lot of it's coming from California, interestingly enough. And I'm sure the Northeast are the guys that are raising money in the Northeast. But most of my guys that I invest with are based California based.
Oh, yeah.
So I saw this deal. I had 4 years left on the lease, and why? They were giving sales. The sales were not super strong. I was familiar with other locations. Jack in the Box went into that market very strong and hot and heavy in early 2000, and they took a lot of shitty locations and they overpaid for rents. But having done the triple nets for almost 15 years at that point, I was comfortable with where their sales were, what they were negotiating, because ultimately they were going to renegotiate their lease. So we bought it at a 12.2 cap rate.
Jesus.
The rent bounced so it was initially an 18-year lease. So year 2, when we owned it, rent bounced again. So we were at like, I don't know, like a 16% return on our money.
Jeez. Wow.
And then I negotiated with them, and we ended up at about a 7.5 cap rate once I renegotiated, but we had already gone back like 60% or 50, almost half our money.
Wow.
Already
From cash flow.
From cash flow.
Yeah.
In those first few years. We paid like $1.4 million, and we were cash flowing, like, I don't know, 160 or so a year. And then it was like 180. And so, yeah, we got a significant chunk of the money back.
Wow.
And so we still own it. It's probably worth, $2.25, $2.5 million.
So they did come back, huh, Warren, at the end of the lease term. Is that kind of the lesson, that everyone was scared that they weren't going to renew the lease, or what was and how did you negotiate the lease after the 4 years?
Yeah, so they, generally a lot of these triple net tenants, they negotiate because they go in paying healthy rent to start, and then they have their kind of every 5-year bumps. And so by the end of the lease are already kind of over market. Not every tenant, but a lot of the tenants. And so the game is really, they come back and negotiate. Very seldom do you see them exercise an option and just automatically take the option rent, which is, say, 10% higher than their last rent. Generally, they come back. Jack in the Box will do a 10-year extension, but a lot of tenants will do 15, 20-year extensions, and then you generally have to reduce the rent a little bit, or in our case, significantly. We went from 180,000 to 110,000. So they'll drop the rent back to kind of in line, but you're comfortable them signing a new long-term lease, and you're happy. So there's some buyers that specialize in that in the marketplace. They'll buy really short leases at higher cap rates. They'll go in, negotiate, and then they turn around and sell them.
Yep. Let's go back real quick.
New York, I know they do that well.
Warren, for people that are maybe a little bit newer, you were mentioning a couple terms that I didn't know, so I'm sure that 99% of the people won't know, which is, you said the rent bounced, so that means it went up, I'm assuming, and then you mentioned a couple things in regards to, like you bought it at a 12 cap, and then you got it at a 7 cap, back to a 7 cap. Can you just kind of explain that a little bit more in detail?
Sure. So was the rent bounce question related to multifamily or triple net?
Triple net, but you can parlay it into multifamily too.
Okay. So with triple nets, basically most of the tenants start with a 15 or a 20-year lease. And then most of the time, unless it's a small franchisee, you'll see every 5 years, you'll see a bump, either based on a percentage or a CPI increase. CPI generally is 2%. So the percentage increase is generally what sticks in the lease. So you'll see most of the tenants have like 10% bumps every 5 years. Jack in the Box, sometimes 8% bumps. That's what I had in mind. I actually own one in Dallas as well. So that's when I'm talking about bumps, that's what I'm talking about. As far as the renegotiation from a 12 cap, or that basic cap rate is what you pay. If you pay all cash, that's your return. So we paid $1.4 million, and we were getting like a 12.2% return. The rent when we were negotiating with them was about 180 and change, and so then the rent dropped to 110. So when I'm talking about the cap rate dropping, basically we traded a new 10-year term, and we dropped the rent. And so now if you take that 110,000 divided by what we paid, it's the 7.5 approximate percent cash on cash, or cap rate, since we owned it all cash.
And the key there, Warren, was you reduced the rent to get the long-term stability.
Yeah. And again, almost half the amount we paid for it was already paid.
Right.
Paid back cash flow in the first 4 years or so.
Right.
So we're still making on the money we invested, not on the equity, because that could be a separate analysis. You could look at a return on equity analysis, which is what I look at for a lot of my clients that are, say they've owned their building 40 years and they've got all this equity, which is kind of similar to what we have in the Jack in the Box. So you've got all this equity, but you're only cash flowing whatever you're cash flowing. And so if you take that cash flow divided by the equity, that's going to give you a percentage. The higher it is, obviously, the better it is, and you're probably going to hold the property. But I've sold a lot of portfolios where people are making 1% or 2% on their equity. So we can take that equity, pop it into a triple net out of state, making 4 or 5 cap triple net, and now they've doubled or tripled or quadrupled their cash on cash, getting away from the headaches and going into something that's super easy, where you're just getting essentially rent deposited into your account each month.
That's a good point, Warren, there. And I know we want to be cognizant of your time. It's Friday here, and I know it's getting later in the afternoon. So I think to segue as one of the final questions, you brought up a good point on return on equity. And that's a really important point, I think, for all investors to decide if they're going to hold the property, refinance, are they going to sell, what's their next move in their business and their business plan. You mentioned, and I remember I sold out in 2019 out of a portfolio of mobile home parks I had, because my return on equity was, I think, in that 2 or 3% range, because I had all these unrealized costs to manage all these different challenging tenants around low income Las Vegas and parts of Northern Nevada. So those assets traded for such a premium, but the actual management cost that I incurred was extremely high. So my return on equity was minimal. So I'm just curious on your end, you're a long-term buyer and holder in terms of your multifamily you mentioned. What are some of the next steps for you to make decisions on your investment career, and how does return on equity, play into that for you?
Sure. So the first batch of apartments I bought from 2010 to 2013 or 2014, I've refinanced several times, and the investors have got back all their money and then plenty on top. So we have no money invested in the deals. So we're cash flowing, in theory, like infinity percentage wise.
Is there a word for that? That's like the favorite thing in real estate, right?
Yeah,
We got to make one up. When you can pull your money out and keep cash flowing, and you just keep infinite return.
Yeah, I mean, that's what most of my clients have done. They've owned forever, and that's essentially what they did, and they went and bought more.
And tax defer, right? No, tax free.
Yeah, tax free. And so, yes, you've got that unlimited return, but then on the other side, you're talking about return on equity. So, say the first deal I bought was bought at $1,750,000. Now it's worth $4 million. So I pulled out all the money. I don't know what my loan is. I'd have to look, but say the loan's 2 million or 2.2. So I've got 2 million or $1.8 million in equity, and what am I making on that number is the question. So say I'm cash flowing 60 grand a year on that small property. On $1.8 million, it's not that big of a percentage, but we already got our money back. So we're making 4% maybe on our money, on our equity. But we took all that money, we just bought more deals. So it depends on the business model. At this point, I have probably at least 50% equity in all the buildings.
Nice.
Including the ones that I bought during COVID, because I was very particular about what I bought. And I didn't pay, a lot of the stuff in LA selling it 14, 15, 16 times gross. And most of the stuff I bought was probably hovering around 12. Wow. Part of that's because the upside wasn't gigantic, so the GRM was lower. But it depends. Like ultimately, that'll be a question. Do we take that equity and do I plug it into, like, say 20 years from now or 10 years from now, when I want to get out of the headaches of running the management side of things, and I don't want to be working 60 or 70 hours a week, kind of overseeing what I oversee. And I don't have a kid taking over my business, which I have friends that have taken over their parents' business or syndication business or that kind of thing. Do I kind of sell everything, pull it all into one kind of chunk of money, and then parlay it into, a Jeremiah deal or a Monarch deal or whatever? Guys that I trust, that have built a business, that have the infrastructure that I don't have. That if I die, my investors, I basically selected some partners that are very involved in the real estate business, but not involved in my business per se, but they're significant investors in my stuff. And they have the bandwidth to take over the management and take over kind of running the day-to-day with the staff that they have. So I've kind of built that into what happens if something happens to me. But ultimately, 20, 30 years from now, I don't have somebody to kind of hand off the business to. So I'll have to do that long-term kind of strategy-wise. So it'll be from that standpoint, but also return on equity. At that point, every building will have pulled out all the money we put in. Our return on equity will be in the low single digits, maybe mid single digits. And it'll need to go probably out of state into larger deals. So ultimately that would be the course, I think, that my business flows and what it'll be.
Yeah. And that gives you the tax advantage as well, right? Is if you get that big exit in LA and you're, like you said throughout the interview here, you're a cash flow investor. So it's where can you get that return on equity to give you that cash flow that's going to allow you to live the lifestyle you want later in life. And maybe is there a better opportunity out there that could provide that stability of cash flow without, and I admire what you're doing without the 70, 80, 100 plus employees and the, 20, 30, 40,000 units of small ticket units in storage or low income apartments. I don't think that's a bad strategy. It's kind of, it's sometimes the opportunity cost of what you have to give up to manage so many people and really and be spread out across the country is challenging. And I like that, you demonstrated that you made an example that you just stuck to this, like Cal Ripken, man, showed up every day and just stuck to the plan, right? And you were consistent. Sounds like, even the way you share and communicate, you're not too high, you're not too low, and you grind it out, but it created a ton of success for you. And you have purely financial independence, freedom, and you can make choices in your life and do what you want to do. So I think people, they got to remember that it's not flashy, it's not sexy sometimes, but I think you pick a plan and you stick with it. And that's a great lesson, Warren. And did you have anything you wanted to kind of share with the younger guys or anyone out there on, just building their career or just in general on multifamily investing?
No, kind of along what you were talking about as far as staying focused. I think actually when I first started brokerage, I put a picture of I wanted a BMW 330 convertible. At the time, that was the car I wanted. And so I put the word focus above the picture, and people would like walk by my desk, and it was kind of like my desktop. And they make fun of me. Oh, you want a Ford Focus? I was like, no, asshole. I'm telling myself to focus. And that's really what it takes. People lose focus very quickly. And I think it's even worse now because of social media. People spend so much time on their phones. I really don't have much of a social media presence. I was talking with Marty about this at the beginning. He was talking about different things that you guys are doing as far as the podcasts and building your own businesses, and people that come on and you couldn't find anything online about me other than my website. And I have a LinkedIn account. But that's really it. Most of my clients have been 50 to 80 years old. They don't give a shit if I'm on Instagram or whatever. They just don't care.
Good for you.
And honestly, I don't want everybody knowing my business. So I've got tenants that they see my name and that kind of stuff. So I don't want to be out there, putting stuff that, number one, would be like privacy stuff for myself.
Right.
I think,
you don't have to.
Yeah. You can build. Yeah, I've got contemporaries in the brokerage business that they've started doing videos, and they do stuff like in LinkedIn, and they do stuff on Instagram, and they do all that stuff. And I still feel like most of our clients are younger, kind of at like the 40% plus. Our clients are not so much in their 20s and 30s. How much does that really grow their business? I don't know. I think, Jeremiah, for you and your investors, like this exposes kind of like what you're doing in your business and who you are. And so it makes sense, like as you're expanding to a much larger footprint than I'll have ever. And so even in the small kind of footprint that I have, you don't necessarily have to do that. So you can really pick and choose kind of what dimension you want to go as far as scale you want to go as far as whether it's social media or the platform you have as far as your business. So getting back to kind of what I've done, most of it I think has to do with hard work. I really worked my ass off for 20 years. I don't need to work. I could give the management to a management company and still not need to work. I mean, I work because I'd be bored. You know, I box. I do that one day a week. I go to the gym and work out a couple days a week. And I have some other hobbies that I'm into, but generally I'd be bored shitless if I didn't work. So I'm building something. I'm basically building it to give my money away.
That's all.
Kind of people are like, why, you know, like, you don't need to. What are you doing? You could travel. Yeah, I travel now, but you know, I can't travel 6 months out of the year. I'd be bored of that. After 2 weeks, I'm ready to come home and catch up on what I need to catch up on and do what I need to do. So, you know, I think focus, hard work, your consistency, all the words you were using are important for success in really any business.
Yeah.
But I mean, I deal with vendors all the time. Most recently, I dealt with a cleaning company, and like the communication skills were awful. Their employees were doing just the bare basic stuff, and I fired them. I was like, dude, I don't know how you run a business like this.
Yeah.
And you know, that's 80% of businesses are run like that. They're just just morons.
It is.
So yeah, you can, you know, plenty of people are happy running a little business. They're a plumber, they're an electrician, they make 50, 100, whatever a year, and they don't want to deal with all the people, and they have their own little business. And then there's a guy that kind of has 5 people working for him, and you deal with the employee issues and the headaches that come along with that, and the state, you know, looking at your books, and the state looking at your employment records, and, you know, unemployment and this and that. I've had my first unemployment claim from a manager I fired because she simply refused to do her job. She wouldn't rent units. She wouldn't return calls. What the fuck are you doing? Like,
what am I paying?
Getting free rent. I'm paying you on top of that. Like, and then she claims unemployment, and I'm just like mind blown. But anyways,
we admire you as a business owner and investor, man. I mean, it's not an
a lot
easy
of brain
job.
damage. Yeah.
It is, and it's small businesses or us, you know, mid-sized businesses, we are employing the country. And I think that the thing that I got out of this from you as well is even in an age of social media and, you know, a lot of flash in terms of, you know, polished presentations and it's glossy and it's shiny and it's got a lot of good graphics. You know, I'm trying to do a few things here and there to get out there. But at the end of the day, Warren, you know what, where I came from and what sounds like you came from, you know, one-on-one relationships. And you just scaled it over time. You did the right thing for the right people, you know, over and over again. And you built up a tremendous reputation. And these people continue to work with you, and they don't even question because they trust you. They know you do what you say. You have integrity, character. So I think people got to remember that. I wrote it in the book, and I felt like, you know, it's such a trite thing to say that relationships are still the cornerstone, the foundation of business, but it really is true. At the end of the day, all we got is our word. And when you do people right and you do it over and over again, and you know what the hell you're doing and you add value to people, and it's not all about you, it's about trying to serve and make things happen for people and know your superpower to help someone else, you know, that you get rewarded for. I think it all shakes out in the end, right? And luck doesn't even play an option in that.
Yep, that's what my wife gave me for one of my birthdays.
That's it. That's why I want to work with people that get shit done, man. So, Marty, did you have anything for Warren? I know it's
well, I would say, Warren, where we find you, I know you're nowhere to be found, but BerzackAdvisors.com is the website. Is that correct for people who want to? Here's the thing.
That's the brokerage. Yeah, the brokerage site.
Okay, so for people that want to find you, I know that, you know, the bread and butter is the, you know, 1031 for multifamily. Well, I should say multifamily extraordinaire. He knows how to do a 1031 and do a triple net better than anybody in that area. So that's where I would say that the people can find you is BerzackAdvisors.com.
I appreciate it.
Thanks, Warren.
Absolutely,
yeah, man.
Warren.
I hope it was worthwhile.
Absolutely, brother.
Thanks.
Appreciate the time.
All right,
we'll see you guys next time.
Okay. For more information on commercial real estate investing, go to patriotholdings.com. Thanks for listening to Finding Your Edge.